Hi, welcome to Hospitality Accounting. Today we're going to talk about Chapter 4, which is an extensive look at the balance sheet. So the balance sheet contains assets, liabilities, and owner's equity accounts. Today we're going to start with a discussion of assets. Assets are items that are owned by a business that have value and provide a future benefit to the business. So if we think about that, what's owned by a business that has value, cars have value, buildings have value, land have value. Well, how might the car, building, land provide a future benefit? Well, if you want to have a restaurant, you need a building, so that has a value. People generally can't buy your food if they don't have a place to come and purchase it, and the building needs to be on land. It can't float in the air. And then a van or a truck to deliver food, if you're doing catering, will provide a future benefit to the customers. They want it delivered. You can charge for that. You may get more business for that. So that's how it's a future benefit to the business. Other assets that we think about commonly are cash, accounts receivable, inventory, and we'll look at them a little bit more and we'll classify them. Assets are classified as either current or non-current. Current assets are expected to be consumed. So when we say consumed, we mean used up. So something like a pencil or a piece of paper might be your supply. That's an asset. It would be consumed or used up. You'd use all the pencil lead or you would use all the paper. Items like inventory, obviously if you had a few pounds of steak, you'd want them to be consumed. They're not going to last indefinitely. They will go bad. Or can be converted to cash, like accounts receivable. So if your customer owes you money, they say they're going to pay you back later, it'll be converted to cash. So if it's either going to be used up or converted to cash within 1 year, it'll be considered a current asset. This current asset classification is extremely important because it helps creditors to understand if you have enough assets to pay back your debt, the debt that is due soon. So again, we have current and non-current assets. I'm going to give you some examples of both. So cash by definition is current because it's anything that will be converted to cash and it's already there. Accounts receivable, again, this is what your customers owe you, the money that the customers owe to your business. So hopefully they pay you back in less than a year. If they don't pay you back in a year, that's a really long time for a receivable. Then we have inventory. So if you're a business and you have, let's just say, vegetables, steak, bread, obviously they're going to need to be consumed or used by the customer, and that'll convert them to cash. I give you the nicely cooked steak and you give me, I don't know, $25.95. And then we have some prepaid expenses. Prepaid expenses are expenses that you have to pay in advance. A good example of this is car insurance. So if you have a delivery van or a truck, you need to pay for the insurance on that in advance. Obviously, the insurance company doesn't want you to drive the van around and then have an accident and then get insurance. That's not how it works. So anything that we pay in advance, rent is sometimes paid in advance. Sometimes advertising is paid in advance, but always insurance is paid in paid in advance. We call it a prepaid expense. And also short-term investments. So these are investments that would be coming due within 1 year or 6 months. They would be coming in. They would be a certificate of a deposit. Might be some stocks that you plan on selling. You have to have the intent and the ability to sell them within the year, but they would go here. Let's come on over to our non-current assets. A lot of times this is called property and equipment. So land and buildings are what we're going to call property, like real estate. And obviously we own them and they should last for longer than a year, right? We're going to hold them for a very long time. Furniture, so things like bed, chairs, desks, couches. I think that's all the furniture I can think of. Tables, anything there that would go. Fixtures sometimes throw students, but those would be light fixtures, vanities, mirrors, all of those things that you attach to the wall, especially thinking about a bathroom, would go here under fixtures. And then I have cars, trucks, vans. You could include any type of vehicle or any type of, moving from here to there, monorails, airplanes, all that kind of stuff. Equipment can be lots of different things. Equipment could be your elevator in your hotel. Equipment could be your freezer, your refrigerator, your prep stands in a restaurant business. And also in a restaurant, we can't forget china, glassware, and silverware. All the things we use to eat off of are very important, and they have a cost, and they are considered an asset for our business. The one thing you may notice that is missing from this conversation are employees. Human resources, although sometimes talked about as being an asset, they mean that they're a benefit. They are not truly an asset in an accounting sense. Because you cannot own another person, they cannot be considered an asset. So sometimes this is difficult for sports teams. So if you were thinking about going in arts and entertainment management, that type of career path, they have a lot of contracts for very expensive players. They can't put that on their books as an asset because human resources employee contracts are not considered assets. Other assets, we have some assets that weren't listed before, and other assets, a lot of these are intangibles. So intangibles means that they exist, but you can't touch them. Some examples that are very important for your industry are trademarks, copyrights, and franchises. So trademarks, I had the golden arches on one of the slides that you've already watched. That's a very recognizable trademark. It's extremely valuable to the McDonald's Corporation. And copyrights means that someone cannot copy what you've done, like a work of art or a patent would go with copyrights. And franchises, so if you purchase a franchise from McDonald's, if you pay that fee and the one-time fee and then are continuing to pay fees every month, that has value to you. That franchise has value, so it's on your books. Your book also talks about goodwill. Goodwill only results when you purchase a business and pay more in cash than the assets of a business. So sometimes you pay more for a business. Maybe it has a good location. Maybe it has great employees. Perhaps it has a good reputation. There's lots of reasons why you may pay more in cash than the net assets of the business. But when this happens, it creates an asset called goodwill. On the other side of the accounting equation, assets equal liabilities plus owner's equity are liabilities. And liabilities are the debts of the business. So anything that the business owes is considered a liability. So you can think about possibly some of your own liabilities, your own debts. You may have a credit card bill that you have to pay every month. You may have student loan debt. You may have a mortgage payment. Those will all be considered liabilities. And a lot of times for businesses, it's very similar. They may have a credit card payment. They may have a small business loan. They may have a mortgage. Again, liabilities are classified into current and non-current. And this is extremely important because creditors want to make sure that you have enough current assets, that you have enough cash or enough that's going to be becoming cash in the near term to pay those debts that are going to be due currently. So those debts that are going to be due in 12 months or less. So we'll talk a little bit more about current and non-current liabilities. Current liabilities, again, will be due within 12 months. I have some typical current liabilities listed underneath there. One's accounts payable. Accounts payable is opposite of accounts receivable. Accounts receivable is what your customers owe to you. Accounts payable is what you, the business, owe to others. So you may owe on a credit card. You may owe on a small business loan. You may owe your vendor for food. You may only pay it once a month. So that's accounts payable. Then you have sales tax payable. In both the hotel industry and the restaurant industry, you must collect sales tax from your customer and remit it to the state and local taxing authorities. Accrued payables are a little bit of an advanced concept, but that means that you have to make an adjustment so that you can recognize the expense. We'll talk about that in a later chapter. Advanced deposits. Especially in the hotel industry, we require a deposit for staying the night. And whenever you receive those in advance of the person staying, that's a liability until they actually come and stay in the hotel. Then we're looking at current maturities of long-term debt. That's very common. If you have a mortgage, if you have a car loan, if you have a student loan, then all of those require that you make monthly payments. The monthly payments that are due this year would be current. Everything else that's going to be due in future years is non-current. And you can see that when we come over here on this side, you can see right here, generally there will be a portion due currently and a portion of the long-term debt due in the future. So we break it up. What's due this year goes in current, what's due in the future goes in long-term. Some other examples of long-term liabilities is notes payable. That's kind of like your business loan. Mortgage payable, which is on real estate, you probably are very familiar. And bonds payable. Bonds payable you can get through selling debt to individuals, to the general public. And you're usually a very large corporation if you have bonds payable. The third part of the accounting equation, assets equal liabilities plus owner's equity, is equity. So we're going to talk about equity. Equity represents the owner's interest in the business, the residual interest after the liabilities have been paid out of the assets. And we have two types of equity. Sole proprietors and partners use a capital account to represent that owner's financial interest. They use something called capital. So it would be, let's just say my name's Amy Cesario. If I were a sole proprietor, it would be Cesario Capital. If I went into a partnership, let's just say with your department dean, Melissa Wirtz, it would be Wirtz Capital and Cesario Capital. We'd each have our own capital account. And then withdrawals is used to show the owner taking money out of the business. So that's the account we use if the owner takes any money out of the business. Corporations are a little bit different. They're set up differently. When you purchase a share, you purchase common or preferred stock, and that's how you become an owner. So we don't have capital accounts. We have common stock and preferred stock. We also have some accounts called additional paid-in capital and retained earnings. We'll start with retained earnings. Retained earnings is where we keep the earnings of the business. So if we have net income this year, we put it in retained earnings. We have net income next year, we'll again put it in retained earnings. And out of retained earnings, we usually track dividends and we track earnings. So that's all that goes in there. This additional paid-in capital is a little bit more difficult, and it has to do with par value, which is on the next slide. So we'll just kind of leave it for now. We'll go to the next slide. So common stock. Shares are issued to owners or stockholders or shareholders. They can be called that. They may be issued at par value. I talked a little bit about par value on the last slide. Par value is an out-of-date concept that stems from business law from hundreds of years ago. And people still talk about it, and some of it is because those businesses from the early part of the century still have par value. But it really doesn't mean anything except that you may have additional paid-in capital. So some of the stock will be called par value common stock, and some of it will be just held as additional paid-in capital. And you can have different classes of common stock. You may have A, B, and C, and they may have different dividend preferential rates. It depends. You'd have to read the prospectus. There is preferred stock, and they sometimes have some different rights than common stock. They get dividends first. They may be able to change their stock, so conversion privilege, either to bonds or to common stock. They usually are paid if the business goes under first, so that's a liquidity preference. If you go bankrupt, they would be paid first. And sometimes they can be called, so the business can say, okay, we're going to call all our preferred stock and create them as common stockholders. So that is the ability to call preferred stock. Some businesses have preferred stock and some do not. It just really depends. And these rights are really spelled out in prospectuses too. But these are some of the differences between preferred stock and common stock. So that is an overview of Chapter 4. Thanks for watching. Make sure that you read Chapter 4 in your text. It'll have more information. And this is also make sure that you're getting your assignments in on time. Thank you so much and have a great day.